This episode is brought to you by Persona. In fintech, one bad actor slipping through onboarding can cost you way more than a lost conversion. It can cost you your compliance standing. Persona gives you the identity verification infrastructure to catch fraud early, stay compliant, and still convert legitimate users without building it yourself. Fintech Takes listeners can claim a free year of access at withpersona.com/FTT. Hello, and welcome back to the Fintech Takes podcast. It's a new month, which means we have a new episode of Fintech Recap with our friend and the publisher of Fintech Business Weekly, Jason Mikula. Jason is coming off of a sabbatical that was somewhat successful and is diving right back into the exciting world of fintech. He and I talk about personal financial management in the age of agentic AI, which is a topic I wrote about on my newsletter. We talk about Bolt, which was at one time one of the competitors trying to solve what I thought was an already solved problem of one-click checkout, and has since pivoted into trying to become a super app, which is a topic and a company that Jason has written about in his newsletter. And we also talk about the PACE Act, which is a new piece of legislation designed to increase access for non-bank payment companies to the US's payment infrastructure. It's a really interesting bill, and I was glad to talk it out with Jason because it doesn't make a ton of sense to either one of us, but hopefully we brought a little bit of clarity to that topic. We also end, as always, with a couple of things that we can't let go of. Spoiler alert, mine is related to a topic that I rant about quite a bit. Jason's is a little bit more fun. Tons of fun on this episode overall, and I can't wait for you to hear it. So without further ado, here is Fintech Recap with Jason Mikula. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Jason Mikula back from his sabbatical, ready to recap more fintech things. Senor Mikula, great to see you.
Great to see you. This is the second podcast I've recorded from my makeshift studio here in Oaxaca. The first one was with your partner in crime, Kia, and Professor Dan Ari, and it went fantastic. So you have a high bar to live up to.
I heard that it went very, very well. I know for a fact that even though you're supposed to not be working, you have not done particularly well in your sabbatical away from fintech. Have you at least immersed yourself in Spanish language learning? Has that happened?
Yeah, so I've been doing, today was actually, as we're recording this, it was my last half day, so 4 hours each day of Spanish class. Half that's like, grammar, and half that's conversation practice. And I will say that, not staring at a screen for 4 hours is both very freeing and yet somehow stressful because it's like, well, what's happening on the screen that I'm not looking at?
Well, and there have been a number of stories, not some of which we will talk about today, that I think seemed tailor-made to sort of distract you from your sabbatical. So even though I wouldn't say you passed with flying colors, I would charitably give you a D+ on the sabbatical. Not totally your fault. I'm sympathetic to it, but also you're supposed to be unplugged, man. You're supposed to be unplugged from fintech.
When you were in elementary school, did the report card have a grade for effort that was separate from the actual grade?
Yes. Mm-hmm. Yes.
All right. I'm giving myself at least a B+, if not A- for effort.
I agree with that.
Actual results, I'll be a little more gracious and give myself a C-, but thank you.
That's fair. That's totally fair. Well, and again, as we will talk about, what were you to do? Just not write about these things. So fintech never sleeps, and I just got back from New York Fintech Week, where lots of energy, lots of excitement bouncing around. I will say going to a proper fintech hub where there's lots of people just there all the time made it very easy to see lots of people, to get people to come to events, to get people to come play basketball. So I am now back in Montana in my little isolated bubble, but ready to talk fintech stories. We've got some good ones. You ready to hop in?
Yeah, and I'm glad that we organized the outline with a classic Alex and Jason topic, a piece that you wrote to just ease me back
That's
into
right.
things as if I ever really left.
Well, let's just pretend that you did. So that is exactly what we did. The first thing I wanted to talk about, which I wrote a piece on, as you illustrated, was a piece on personal financial management. So PFM, a topic that I know you are very familiar with and have spent time on in the past. I have spent a lot of time on over the years. It's an area where I would consider myself sort of a fan, but very much a fan from the perspective of this is a thing I would like to exist in the market. Not necessarily a fan of, I think this has been like a great investable category for venture capital investors over the last 10 plus years. The concept, as we all know, is very, very simple. Giving consumers information and tools to help them improve their financial situations and trajectories. There are two questions as it relates to PFM that I think we haven't totally figured out, despite, again, many generations of founders trying to build in this space. The first one is, what is the ideal UX for the product? What is the best way for consumers to experience the process of managing their finances? And, this question is really grounded, I think, in the idea that, well, everyone says they want help managing their finances. Very few people, anywhere from 3 to 5% on the low end to maybe 10 to 15% if we're being very generous, actually want to actively manage their finances and budget and categorize their expenses every single month. It's like a very small percentage of the population. And the rest of us, well, we might aspire to that level of like organization and sort of oversight. That's just not either how our brains work. It's not something we have time to do. It's not something that kind of makes sense in the way we think about money. And so most people don't manage their finances in a proactive way. So what's the best user experience for getting people to actually engage with their finances or help them manage their finances without them having to be engaged? That's question one. Question two is, what's the ideal business model for a personal financial management app? And this gets us into the multiple generations of PFM apps that have existed. So obviously, Jason, you remember Mint.com. Were you a Mint.com user?
Oh, I was a diehard Mint.com user. Actually, up until I was working on Marcus at Goldman.
Yeah.
And, I am not, as the listeners will know, I'm not a software engineer. And at that point, hadn't really thought a lot about this. And this was still, screen scraping was still quite prevalent. And one of the engineers that worked with me, actually, I'm building an integration with Credit Karma to do loan pre-qual, was explaining to me sort of how Mint or services like Mint went about accessing my data, how much of my data they were accessing, and what they may or may not have been doing with my data and to secure my data or not secure my data,
Yes.
which definitely freaked me out.
Yes.
So eventually I did actually stop using those kind of tools and just became like the Excel/Google Sheets guy.
Got it. Well, you're one of the 3, 5, 10, 15%. And actually, it's funny because a lot of people in fintech, I think, used Mint.com. I think a lot of people in this industry were actually introduced to the idea of a consumer fintech through Mint.com. It was very popular at the time. And so that first generation of tools, of which Mint was one, you mentioned Credit Karma, I would say that's another one that fits into that category. Slightly different products, slightly different business models, but fundamentally digital dashboard populated by bank transaction data, which, as you just said, bank transaction data in the very early days was a lot of screen scraping. It was a lot of, let's say, maybe not totally authorized use or reuse of the data in different ways. You could review and categorize your transactions. You could build budgets. You could set saving goals. With Credit Karma, you could find out what your credit score was, what products you might be qualified for. And then from a business model perspective, and Mint and Credit Karma are both great examples of this, it was a lead gen business model where lenders paid for referrals or new customers that came from those platforms. So that was generation one. Obviously, that generation has kind of fizzled out. Ironically, Intuit ended up sort of sucking up a lot of this. And so they bought pretty much all of, or many of the personal financial management apps.
I'll push back. I will push back a little bit in the sense that Credit Karma was a wildly successful as a business.
It was.
Now, as a PFM tool, as a tool to actually help people improve their financial life or financial health, I'm guessing probably much less so. But I can tell you, when I worked at Goldman, I saw how much money we sent out every month in lead gen fees to Credit Karma. So definitely a successful business, if not a successful PFM.
That is exactly right. And 2 notes on that. One is that you're absolutely right that the core product with Credit Karma was not like budgeting, categorization, those things. It was much more weighted towards credit shopping behavior, which of course is much easier to monetize. And I would actually argue that Mint.com, by sort of blending together the budgeting and categorization, which we sort of think of as more classic PFM, with that same business model, kind of put it in the worst of both worlds categories a bit, where it's like, this isn't really what people came to the app to do. I think they found it a little off-putting or strange, but it also was something where they wanted to offer the product for free. And the only way to do that and still make money was to be able to sell ads against the data and against the users that were in there. So coming out of that generation of PFM, which varying degrees of success, most of which were either acquired or then kind of went away, we now have what I would sort of classify as generation 2. And this is Monarch, Copilot, YNAB, which is a bit of an older example, but sort of fits into this same category, because in generation 2, the UX kind of stays the same. It's still the same: connect your accounts, see all of your transactions, set a budget, set savings goals, maybe be able to look at your credit score. Like, it's the same rough set of capabilities and the same sort of user experience that you would get with like a Mint.com. But the critical difference, and if you talk to the founders of these companies, they will say exactly the same thing: the business model evolved. And the sort of thinking from founders who sort of learned from watching Mint.com and Credit Karma and others is, it's really difficult to build and sustain trust, broadly speaking, beyond maybe just credit shopping as a narrow behavior, but to sort of become a full service personal financial management assistant or app or tool, if the user thinks that you're selling their data, profiting from their data, selling them as leads, not recommending products that are necessarily the best products, but are products that are just, hey, these are the ones that people pay us to hawk. So all of them offer a subscription, and they believe that a subscription business model is the best way to keep those incentives between the product and the user in place. That, I think, has some merit. It also challenges those companies from a business perspective, because, again, how many people want to actively manage their finances, and how many of those people are able and willing to pay for a tool that charges a subscription fee, even if the founders of those companies think that business model is better aligned with the long-term interests of customers. So I have not gotten the sense that any of those companies are crushing it in terms of like massive growth. I think they're doing well, to be clear. And I think their users who pay for their product and use their product actively love it, but it still seems like we're bumping up against this kind of ceiling of how many people are really going to want this. Is PFM just going to be a niche product category forever? However, and this was sort of the newsy part of the article I wrote, and what I really wanted to get your take on, Jason, is I think we're starting to see some evidence of what I would consider generation 3 of PFM. And the key change here, we don't know exactly what the business model is, and we can circle back to that in a second. But it seems clear to me that the change with generation 3 from generation 2 is that user experience, and the idea that large language models and agentic AI might be a better way for people to interact with, manage, supervise, automate their finances and their personal financial management. So a couple things happened. Perplexity teamed up with Plaid so that Perplexity users could permission their financial data using Plaid to give Perplexity access to it, and then presumably to be able to kind of ask questions about their finances and sort of manage their finances. We had OpenAI acquire Hiro, which is a personal financial management app that I didn't really spend a lot of time learning about. It was the second company built by Ethan Block, who created Digit back in the day. Another one of my sort of personal favorite early generation personal financial management apps. We have Revolut, Cash App, and Public, who have all introduced sort of AI agent or AI chatbot type functionality built into their apps to, again, sort of create this new interface for asking questions and getting answers about your money. And Jason, my question for you is, will this new format, this new user experience, this new modality make a difference versus the many, many prior iterations of PFM that have all sort of used that dashboard, budgeting, categorization, savings goal interface? Is this the thing that will unlock more success for PFM as a category?
Yeah, I mean, I guess not to turn that back into another question, but is the point of PFM to surface information and insights, or is the purpose of PFM to change behavior? Or I guess both of these things together, right?
Sure.
So when I think of, the kind of people who were hardcore Mint users or YNAB users.
Yeah. Shout out Kia Hazlitt.
That was the implication, yes.
Yeah.
It's people who are self-selecting to have that level of involvement and awareness of their financial life. And chances are, like, they would do it even if those tools didn't exist. Like, at some point during this very long journey I've been on, I did actually make a side trip to Chicago, which I did not disclose publicly for various reasons. And I literally was watching my dad, who is in his mid-70s, enter something in the check register of his checkbook.
Yeah.
So it's like, I think that there is a mentality, a personality type, however you want to sort of bucket that, of people who have either learned, been taught, they've seen this behavior modeled, which 100% clearly was my case, or otherwise have made the decision to have a very high degree of sort of information salience and control over their financial life. And so if Mint.com is making something I was already going to do, whether, bless his heart, in my check register of my checkbook or in Excel or Google Sheets, if it's making that easier and to use our favorite, fintech or tech speak, take the friction out of it, it's helping me do something I was already going to do anyway. I think where most of these platforms have fallen short, and as I recall you specifically sort of talk about this in your piece or in the introduction you just gave, like the TAM, like the percent of people who actually run their life that way is limited. It 10%, 15%. It's not 80% of the world who's sort of running their financial life that way. And so the question I have, and I don't think we have an answer yet, but I'm curious to hear your point of view. What I'll be watching for is, do LLMs or do AI agents, are they solving this information problem? So we have a new UX where I can ask ChatGPT or I can ask Claude, how much am I spending on Uber last month? Or how can I, save more money? Like, that's an information problem. It's not that, at least to me, doesn't encapsulate actually encouraging behavior change. So I think that there's a second piece of this around the agentic stuff, which actually I think might enable people to spend money more easily, which may not be in line with their goal, although perhaps it also helps them save or invest more easily. But I mean, do you think about it roughly in the terms that I'm laying out here?
Yeah, no, I definitely do. I mean, I think it's to use open banking speak, it's kind of like the difference between read and write access, right? So the read functionality is, hey, I want to know information about what's going on in my finances. A lot of times the value proposition is like, show me what's happening across all of my finances. I want to connect all my different accounts. I'll pull all this data in and I'll get like a bird's eye view of everything that's happening. And I do think we do know that the modality of a budget with transactions and categories and like bubbles and all the things that we've sort of seen in PFM over the last 10, 15 years, we know that's only appealing to a subset of people. And so I do think, just narrowly on the information question, there is potential for natural language interfaces to be a different way for people to get information about their finances. Like if I can just ask a chatbot like, hey, did this transaction go through or whatever, if I can just ask questions in a natural language, that probably widens the appeal of PFM solely from an informational perspective. I will also say, and I didn't write about this in the piece, but it just occurred to me as you were talking, I think that it's really beneficial to the AI providers, because if you've used, Claude or ChatGPT or what have you, one of the things they always try to encourage you is, you came here to ask a question, turn on notifications. So when the answer is ready, we can come back to you. And I think that there is this struggle that all of the AI providers have where it's like, we are not a tool in someone's lives that notifies them when something happens. They come to us when they have a question. And so I think PFM and the ability to like monitor what's going on in your finances, and for, Claude or Perplexity or whatever to tap me on the shoulder and go, hey, I just noticed from the connected accounts you have that this transaction seems like it might be fraudulent, or your bank just notified you this, and I wanted to let you know. Like, I think the idea of PFM apps being able to sort of like provide AI companies with the ability to have a more engaged two-way relationship with users, I think that's part of the appeal to like, OpenAI buying Hiro, for example. On your point about the right access or the behavior, I think obviously that's where the value is for the users, right? Is like, don't tell people like what's happening in their financial lives, change the trajectory of their financial lives. And I think this is where that 10, 15% problem comes in. The 10 to 15% people who like are really plugged in and actively using this from an interface perspective, let's be honest, they don't really need that much help like getting their finances in even better shape. Like they're pretty on the ball. They're very involved. They want that kind of informational advantage as you were talking about. So I don't think that those users benefit as much from a behavior change, because their behaviors are already probably pretty good. And this is just sharpening an already sharp tool. I think the potential for behavioral change, and I wrote about this in the piece, is I sometimes compare financial services to healthcare because it has a lot of the same things, right? It's like very trust driven. It's high stakes, it's outcome based. Like there's a lot of similarities, highly regulated. But one of the differences between physical health and financial health is that in physical health, there really is no shortcut for us having to actually do the right things personally, right? Like I have to eat right. I have to go lift heavy weights. I have to get cardiovascular exercise. Like I have to do those things myself. And you can wrap tools and guides and coaching and all these things around it, but I have to do the thing. I think, to go back to like Digit as an early stage example of this, because obviously that has some lineage now into what OpenAI is doing. Digit was great because it automated the process of pulling money out of your account. So I didn't have to have the discipline of behavior change myself. It could sort of automate a part of that and do it for me. And so the idea of like right access applied to AI agents and personal financial management is intriguing to me, because there's all kinds of suboptimal things people do because they just don't have the time or energy or care to do it themselves. So like, should I be chasing a higher yield by switching from this savings account to this savings account? Should I refinance when rates drop and I can get a lower interest rate on my loan? Should I just insert more friction into this process where I'm bleeding money right now, and have some like extra layer I have to go through and manufacture friction for myself before I can take that action? All of these are things that have been very difficult because there's like a level of like human intelligence that you have to kind of layer on top of simple automated tools. And I'm curious if LLMs can help there. Now, I imagine, Jason, where your brain might go to when I'm describing this is Block got itself, or I should say Digit got itself into some trouble when it was like overdrawing people's accounts. And like, so like the automation has to work well. And I don't know that I feel like AI agents are reliable enough yet to do this. By the way, did you see the news story about the tech company who's using AI agents to code, and their main agent deleted their database and they had no backup of it? Like, violated every rule that they had for this AI agent, explicitly was told, like, if you're going to take one of these 7 actions, check with a human before you do it, like all the guardrails in place. And the agent did it anyway. And then when they asked the agent why it did that, it was like, oh yeah, sorry, my bad. Like, you're right, I screwed that up. And it's like, AI agents still screw things up on a pretty fundamental black and white kind of basis. And so I don't know that it's ready technologically for that level of right access, but it feels like if it could be, that would be where the lift for that other 80% who aren't doing this work day to day themselves, like where it could be. What do you think about that?
No, I don't disagree, right? As you were talking through that, and the Digit example is a great one, minus when Digit promised that it would never overdraw people's accounts, and then it did.
Yes. Yeah.
Which I believe it got a consent order with the CFPB for. RIP CFPB.
Well, yeah, what is that? I don't know what that is.
I mean, what was occurring to me is like, there already exist automations that are not, fancy LLMs and buzzword agentic AI, right? What is having a 401k contribution come out of your payroll every 2 weeks, if not an automation? Or like the classic debit card feature that was cool 10, 15 years ago, roundups. So when you went to buy something, it would round up the transaction of the next dollar and deposit the money into a separate sort of savings account. And so I think, ostensibly things like LLMs or, agentic tools are, general purpose technology, can be used for good or can be used for evil. And I think to your point, like in the positive path scenario, consumers are using them or companies are developing capabilities around the kinds of use cases you said, right? Like, oh, well, I'm busy. I can't, track mortgage rates and do the math to say, is it worth the closing costs and whatever other fees to refi my mortgage? How much do rates need to drop for that to make sense? Like, that is a real potential positive use case. Same thing with, monitoring rates on high yield savings accounts. At the same time, as we've amply seen with, again, classic example of Uber, reducing friction on the spending side or the access to credit side, encouraging users to borrow more than they can really afford to borrow, spend more than they can really afford to spend. And so you're taking an optimistic view on this, which I appreciate because I need to hear that in my ears sometimes. But I think there's also, potential downside risk, not just in the accuracy issue that you raise, which is a very real one. What happens if my agent sends my loan payment off into some black hole and then, I have to fight to reverse that transaction? But also, the real potential that these kinds of tools or systems are used in a way that is welfare destroying rather than welfare enhancing.
I think that's an absolutely fair concern. I flagged this with agentic commerce a bunch, right? Like you would never know. You would think from the level of excitement that the industry has for agentic commerce that the biggest problem in the world is that consumers don't know how to spend money online. And we have to make this easier. And it's like bullshit. That's the last thing we need to further optimize. Now, obviously, it's within the interests of Visa, Stripe, MasterCard, PayPal, Google, on and on and on, to enable more commerce and to enable more transactions, but it's not aligned with the customer's biggest problems. And I think, to your point, the last thing I wanted to mention about this is the business model question, right? Because with generation 1, the predominant business model was we will sell leads and we will recommend products based on who pays us the most money. And that was very lucrative, to your point, but not very well aligned with the interests of users. Generation 2, I've been surprised to the degree to which founders are like, rigorously, like, we will only ever charge via subscription because it's the only way to make this work. Customers won't trust us otherwise. And I give those founders a lot of credit for landing on that business model and the clarity of like that alignment with the user. With LLMs and AI involved, the surface area of where this is going to live and what it looks like completely changes, right? So to me, there's 3 potential models. One is, and I'll just use Perplexity as an example. Perplexity could have just like a pro version of its offering. It already has multiple pro versions, but it could have like one that makes personal financial management as a capability enabled by Plaid and other data aggregators, just a premium feature for premium users. And you pay $15 a month, $10 a month, whatever it is for that service. Probably it does a bunch of other things too. So like PFM is one of many sort of premium add-ons that's kind of built on top of it. So I could see that. That has the benefit of being aligned with users' interest, right? So if, in theory, Perplexity would not be incentivized to like get you to spend more money than you want to spend or push you down like a path that you don't want to go. So I like it from that perspective, but not everyone will or can afford to spend $10 to $15 a month on that premium AI subscription. So there's a concern there. Second model would be to say, well, like if let's use OpenAI and ChatGPT as the example. ChatGPT has 900 million users. Most of them are free. It's going to be very unlikely that they're going to be able to convert even a large portion of that 900 million free users into paid users. So they have to find a way to monetize the free users who will always be free users. We know that ChatGPT is already rolling out ads. I will say off the top that I am very concerned about the potential for an AI agent to be a much more effective sales person in my feed or in my app or in my sort of digital interface than even the best written like static ad that appears on Google or Credit Karma or what have you. Like an AI agent, these things can like emotionally manipulate people. And if it is incentivized to sell ads and to make financial product recommendations, it's probably going to be way more compelling than any ad that's ever existed in the history of mankind. So I worry about potential misalignment there. And OpenAI doesn't have what I would call the greatest track record in the world of like being super careful around this stuff and like and moving in a cautious way. And then the third model is, of course, the like public Cash App Revolut. We're going to embed this capability within our ecosystem. Cash App has MoneyBot, which is like kind of Claude for your money in some senses. You can ask it about what's happening. It can look across all the data that Cash App has about you, answer questions. Eventually, I'm sure it'll like make recommendations and stuff. Sounds great. And the benefit of that is that Cash App can spread the cost of that out across all the other things they do. So they can subsidize me getting access to that tool for free. They are incentivized to make sure I'm a good, healthy user of Cash App services. They're not going to show me weird products or do anything like that. But they're also not going to recommend things that are bad for Cash App, right? So if I can go get a higher yield savings account somewhere else, MoneyBot's not going to make that recommendation to me. So it's limited by the scope of the ecosystem that it's operating in. So none of these feel like great answers. Do you have one that you like better than others? How do you think about the business model side? This episode is brought to you by Persona. Every fintech founder hits the same wall. You need to verify users, but off-the-shelf solutions aren't built for how your product works. Persona is the identity verification platform that puts you in control of your flows with the automation and scalability to take you from your first 100 users to your first 1 million without replatforming. There's a reason that companies from YC-backed startups to publicly traded fintechs run on Persona. And right now, Fintech Takes listeners can claim a free full year through Persona's startup program at withpersona.com/FTT.
Yeah, I mean, being somebody who actually does pay for my checking account because that is normal in Europe, like I know. I'm less averse, just like personally speaking, purely from a personal standpoint. Like yep. I'm less averse to the idea of paying a subscription fee for a service if you find that service valuable. I mean, similarly, and this drives Kia crazy because I don't optimize my rewards. And I've said this a zillion times in various conversations, but it's like particularly in the Netherlands, Belgium, Germany, it's like, well, actually all of the Eurozone, debit is regulated at 20 bips interchange. Few people use credit. Credit is regulated at 30 bips. Rewards cards basically don't exist. And for your average American, they see that and they're like, oh my God, you're, quote, giving up, end quote, all these rewards. And without going into that whole morass of like complex cross subsidies and who's really bearing the cost of funding those rewards. It's a much simpler and more transparent pricing structure. So from a personal standpoint and sort of like an ideological standpoint, like that is my preference. But to your point, how many people, what percent of people are going to opt in and say, I'm willing to pay $20 a month for this money bot that actually has a fiduciary obligation to me? And I would love, actually, sometime we should talk to a lawyer about like how you would actually assess if the AI bot is like adhering to like a fiduciary standard. Because as you were talking through your scenario, I'm imagining like Claude convincing me I need to like invest in some crazy interest rate derivative product instead of like an ETF.
Yeah.
And I mean, the points you make about this type of tool embedded within a banking app, as you were talking through that, I was also thinking of, weren't you a Cap One interest rate victim?
I was, yes. I was victimized by Capital One's trickiness in keeping their deposit betas low, which of course every institution is incentivized to do. And so you're absolutely right. And, I don't know that any one of these is a perfect answer. I mean, I do actually think there is a real need in the US to break our addiction on the idea that like financial services should be free. Like, I think that's just a huge disservice. And I think that, even when you talk to like consumer advocates who raise a good point, which is, well, like, is this subscription something that would make it unaffordable for the people who most need it, right? And so like lower income households. I think that's a valid concern and something to definitely be aware of. But I also would push back just a tiny bit on that, because I haven't seen really good research on this, but like even low income households spend money on certain subscriptions and things. And like, I think in some ways, the lack of interest in paying a subscription for this has always been more a function of the value it provides and less about the actual absolute cost. Like, I can't afford that. And so I do wonder if AI allows us to flip the paradigm a bit, where the value it provides is so overwhelmingly positive that even for lower income households, it's an expense that they view as worth it. And I think that's a great bar to shoot for from a product perspective and a reliability perspective. But I do worry about it. We don't have time to get into like the agency law with AI agents, but that's a great thing to put a pin in, because I've heard that discussed by many lawyers over the last 18 months. And the line that all of them pretty much deliver is software is not allowed to be an agent as a fiduciary. A company can be, although OpenAI probably won't want to be. A person can be, but software, at least the way the law is written today, it cannot be. And so we're rushing towards that problem as well. Jason, speaking of rushing towards problems, you had one of the main stories that brought you out of your sabbatical and interrupted your sabbatical. Tell us what's going on in the exciting world of one-click checkout.
Okay, do you remember when this was like the hottest product category ever, seemingly?
Oh, I remember.
Not just in fintech, but like in like all of VC land. It was like one-click checkout.
Yep. Everyone was racing to win the one-click checkout sort of contest, which I remember writing at the time that was strange because one-click checkout already existed and it didn't feel like there was actually like a huge gap in the market that needed to be filled. Like Amazon had been doing that since the late 90s. So I was a little confused at the time, but that didn't seem to matter with the VC money getting thrown into this area.
Yeah, I mean, so I was looking back through memory lane, and specifically, we're talking about Bolt at the moment. The last round, at least as far as I'm aware, that Bolt raised was $355 million at an $11 billion valuation, which was announced in January 2022. So it was really in the peak of that COVID, in retrospect anyway, delusional thinking that the future had been pulled forward and everyone had their graphs where like the line of e-commerce just like abruptly jumped like 15 points and then just went, continued linear from there and things were going to stay that way forever. Obviously, that is not what happened. You pointed out, Amazon on its own site has had one-click checkout for a long time. and it's actually been available Amazon Pay on third-party sites. As best I can tell, that was never really a thing that took off. And of course, we also have had PayPal since the late 90s and Stripe, with both of which more or less kind of play in this space. So I'll admit, like, in that mania of Bolt and its peer cohort company, Fast. Do you remember Fast?
I do.
I think it had the same shade of pink, actually, that Klarna uses, more or less.
It did.
Fast,
it did.
Well, as the name, I guess, makes the perfect pun, was quicker to implode than Bolt. So Bolt, I'll admit, like, apart from the occasional crazy headline, I really hadn't been paying much attention to this company. It was this blip in time COVID thing, a lot of drama around the founder. And then, like, I wasn't paying a lot of attention. But the co-founder and CEO, Ryan Breslow, actually resurfaced, at least in my world, resurfaced to give a fireside chat at Fintech Meetup last year, so 2025. And I did actually catch, I don't know, about 3/4 of his fireside chat. And I guess that appearance, which was kind of a mea culpa to explain some of the drama around like a $30 million loan he had taken from the company, and there were like lawsuits and whatever. So it sort of served as his return to the CEO role, as well as announcing, or plus or minus timing this with the announcement of Bolt's pivot to describing itself as a financial, quote unquote, super app. I, based on some incoming tips, was sort of taking a look. It doesn't look like its super app has actually gained any kind of significant traction. So Bolt is working with Synctera and Midland States Bank. The Android store, or the Google Play Store, they've rebranded that so many times, I can't remember what to call it, shows only about 5,000 downloads. I myself tested trying to install the app and onboard, and the onboarding flow is just riddled with obvious UX errors and bugs. I mean, borderline unusable. The functionality of the app itself is quite limited. Basically, it offers crypto, a bank account, debit card, and what it sort of describes is AI shopping, AI-powered shopping, sort of chat interface kind of thing. That barely worked, had minimal products, and many of the products that showed up were from another Breslow-affiliated company, love.com.
Oh, God.
We don't even have time to go down that side quest. But basically, through my reporting, I learned that Bolt has terminated nearly all of the contractors, so freelancers it was working with, laid off about 1/3 of its staff. And in fact, some of the staffers were notified the same day Breslow took the stage again in Vegas to be interviewed, I kid you not, on the topic, do consumers actually want a single platform to manage shopping, payments, identity, and rewards? So classic fintech craziness. In separate but somewhat related news, Bolt also recently filed a lawsuit against its own former CEO that included a number of allegations, specifically that the CEO basically stole intellectual property and trade secrets from Bolt and used that information to form his own new startup. I did think it was notable that according to that complaint filed by Bolt, that former CEO got a $12 million cash payout when he stepped down from the role in 2024 and was replaced at the time by Bolt's head of sales, Justin Grooms, with Breslow ultimately returning to the company as CEO in early 2025. $12 million to step down is not a bad deal, is it?
It's quite a parachute, yeah.
So I guess the TLDR question that I want to ask you, why are some founders still so obsessed with this super app idea or super app language? X, which you and I both still use,
sure,
which is apparently imminently launching its X Money product. Also, Elon also uses the language super app to describe his vision. Who is this for?
That is a great question. I wish I knew the answer. I will say before I answer that question, on the lawsuit that Bolt fired against its former CEO, stealing IP and trade secrets. What IP and trade secrets? So like if you have to show damages, like don't you have to show that the thing that was stolen was valuable? There's no evidence that like what Bolt has built is valuable, or they know anything about how to build anything someone wants in this space. So that seems like kind of a silly lawsuit. To answer your question about the super app, I guess I think it's a function of fintech founders looking at banks and sort of wanting what banks have today without any idea of how banks got to where they were or how they earned what they have, right? So, like most banks are multi-product institutions, right? And so they are functionally super apps. We don't call them super apps. It's not branded as a super app, but like JP Morgan Chase is a super app. Bank of America is a super app. SoFi is a super app if we're using the definition that all these other fintech founders seem to be creating. And I think what I've noticed about fintech when it works well is fintech has zero tolerance for any part of a bundle of products being shitty at all, right? So like the whole unbundling thing was, hey, this thing that you've assembled kind of sucks, and most of the things that are a part of this bundle are suboptimal, and the internet allows us to just level out distribution so we can all get to the same customers and compete for them. Therefore, we are going to unbundle all the things you do, and we're going to do this one thing better. And I think that, good fintech apps that kind of build slowly over time, what they do is they unbundle one part of what banks do. They do it better than that bank does. And then over time, they slowly earn their way into adjacent areas. And so they'll slowly rebundle and add this, or then they'll add this. And they kind of do it one piece at a time. What I see from these folks who are starting from zero and say, we're going to build a super app, is a lack of discipline around trying to do any one thing better than what banks do, and instead trying to jump right to the end state that they are jealous of that banks have, which is this sort of suboptimal bundle of things, none of which are very good. And I think, and this is why super apps haven't worked in the US, US consumers, we've trained them to be too intolerant of this. Like US consumers don't want this. They don't want shitty products. We're happy to have 19 different apps on our phone to get the best of every single thing. And by the way, relating to our previous conversation, if I can have an AI agent that orchestrates my use of a bunch of different services and I can just interact with the agent and it sort of takes care of everything on the back end, that is an unbundling force that may actually prevent new bundles from being formed. Like that reduces whatever additional costs or frictions are associated with having a bundled solution today. So I don't see anything, at least in the US market, that suggests that people want a super app filled with sort of suboptimal products. And I don't think it's possible to go from 0 to 1. And this is what we'll see with X and Twitter and Elon Musk, who, by the way, his first job was working at RBC a million years ago. So he's been obsessed with the idea of building a financial super app since the very beginning of his career. So this is him sort of returning to one of his first ideas about how the world should work. I'm very suspicious of the idea that even Elon, as sort of reality warping as he can be, will be able to jump from 0 to 1 to having a great bundled super app where all of the individual components are truly best of breed. Like no one can do that, including Elon Musk. And I think obviously Ryan Breslow and Bolt is like, you are no Elon Musk, sir. And so I just feel like there's no evidence to suggest that this is going to work on a narrow basis with Bolt or broadly for anyone trying to run the strategy.
I mean, I think that the point you just made that resonated the most strongly with me is American consumers have absolutely shown a tolerance to have 10 different apps on their phone.
Yes. Yep.
I don't have the numbers in front of me, but I would venture to guess that most US consumers do have access to Zelle, but they still choose to use Venmo or Cash App because to open up my banking app, click the right button to find Zelle, like find the contact for my friend who probably isn't on Zelle because they also hate using it. It's easier to actually just use Venmo, both from a UX perspective and from a network effects perspective. And like consumers have shown a willingness to do this. I'll use Robinhood for this. I'll use, I guess, Coinbase for that. I'll use Venmo. And to provide a strong enough incentive to change that behavior, I've not seen, if I had to point to the company that I guess has seemed to do the best job, SoFi has done a pretty decent job of having a wedge product, private student loan refi that it used to carve users off and then cross-selling them into other products. I'm not going to use the word super app. I guess Robinhood with its Robinhood Gold subscription bundle arguably has like done a decent job of having one thing that attracts a user and then creating value in other product segments, credit card rewards, to sort of cross-sell its most, I was going to say most addicted users, but most enthusiastic users. But there really is not a good example I can think of a company who's done this at a meaningful scale. Can you think of one?
No, I don't think so. I mean, I obviously there's examples in emerging markets of super apps, right, that people talk about. And by the way, those super apps are inclusive of a whole bunch of other non-financial services activities. And I think that's the other part of the argument here is that if you want to really be a super app, you sort of have to be like DoorDash, Uber, entire banking ecosystem, telecommunications, grocery shopping, e-commerce. Like you have to bundle at a much bigger level. And of course, the problem in the US is like if you think designing a financial super app is difficult from a competitive perspective, try building the actual size super app that we at least see work in other markets. And there's no guarantee that even if you did that, it would work here because again, different cultures, different markets, different regulations. Like I don't think these ideas are transferable. So the super app idea has always been, to your point, I think, flawed and more of a concept. And I guess the way I would sort of end my point on this is, I think when someone says the word super app, it tells you more about them than it tells you about their product or their strategy, right? Like it tells you something about their level of sophistication, experience, savvy, laziness. Like it tells you something about how they want to build and what their objectives are, and less about like, is this actually a good idea? Because I think the jury is back on that and we know that it's not.
We should put a pin in it there because I don't want to go on about super apps in other countries and what that term means or doesn't mean. Do you want to do our last story for this month?
I would love to, yes. So this is the PACE Act. So Payments, Access, and Consumer Efficiency, introduced by a couple of representatives in the House of Representatives, both from California, which take that for what you will. And the PACE Act is designed to widen fintechs' access to the U.S. electronic payment system and to lower the cost of payments. So while the bill itself does not have a companion bill in the U.S. Senate yet, it does have the support of the Financial Technology Association and the Digital Chamber, which is a trade association of blockchain technology and other digital currency companies, along with, I'm sure, others who have come out in support since I put the notes together for this outline. Originally, Jason, I was kind of thinking of this as a move to sidestep, essentially, the states and the need to get money transmitter licenses. We've seen versions of ideas like this kicked around. The OCC, roughly 10 years ago, sort of started down the path a couple of times, start and stop towards, hey, should we have a national fintech charter? Should we have a national payments charter? Is there a way that we can carve off sort of a different category of providers underneath our existing authority to make it easier for these types of entities to get access to Fed master accounts and other sort of payments infrastructure that they need in order to deliver payments to end customers? That is not exactly what this one does, because one of the requirements under this proposed law is that a company that wanted to become a registered covered provider, which is kind of the new category that the law is trying to create for this category of companies, they would actually have to obtain MTLs in at least 40 states and maintain one-to-one reserves, so with no lending of the money that you're transacting with and holding on behalf of customers along with meeting OCC prescribed risk management and record keeping requirements. So similar in those ways to kind of what stablecoin issuers under the Genius Act are required to do. And the purpose of this law, it seems, is to create a path for non-banks to get access to Fed master accounts. Because as you know, according to the law, the Fed is somewhat limited in its ability, even if it wanted to provide Fed master accounts to non-bank providers. There's been a lot of drama around this particular point over the last couple of years. We've seen novel sort of state-chartered institutions try with limited success to get access to Fed master accounts. We have seen, different companies sort of try to find other ways in to qualifying for a Fed master account. I think that's actually one of the driving forces behind the interest in national trust bank charters, which you've written about, is this idea of getting access to a Fed master account and qualifying under the Fed's criteria as being lower risk to get access to that. So this would seem, the way it's described, likely that entities covered under the PACE Act would fall into tier 2 of the Fed's current sort of risk framework for master accounts, meaning that these institutions would be federally regulated, not state regulated, but they're not insured by the FDIC. So higher risk than sort of a traditional national bank that takes deposits and is insured by the FDIC, but lower risk than some of the more novel state chartered institutions. And I don't know, I guess I find this to be a pretty interesting proposal because on the one hand, this is coming from Congress, right? We don't know if it's going to go anywhere, but like this is not the same thing that we had before where the OCC was just trying to sort of freelance on its own and try to do something. Obviously, that ran into all kinds of like legal challenges. Our friends at the Conference of State Bank Supervisors really did not like that idea and pushed back strongly against it. So this effort seems to be more of a, let's do this the right way. We'll have it come from Congress. I think the requirement to get 40 MTLs is basically a way to get CSBS to chill out and to like be okay with this idea. So on the one hand, I kind of get it from that perspective. But on the other hand, it seems like a lot of work. And I don't know that it actually fully addresses the problem that they set out to solve. And I'm not even sure that like this guarantees that the Fed would be chill about giving all of these registered covered entities, if this law were to go into effect, access to master accounts, because as we've seen, the Fed maintains discretion over that, and they exercise that discretion in pretty aggressive ways at times. So what do you think? Is this like a promising avenue for innovation, or is this just like something that's never going to go anywhere?
Yeah, so I read the actual bill text this morning.
Yeah.
And it had many references to the Genius Act, which I thought was interesting. When you take that in combination with the fact that there already is a Money Transmission Modernization Act framework, which sort of started in 2021, which let's say is an attempt to harmonize standards across I think it's 49 states and then whatever territories that require money transmitter licenses. Plus, a lot of what I saw in the PACE Act actually is just echoing requirements that already exist under MTMA prudential standards. So you mentioned having to hold essentially dollar for dollar the money that you're moving. So I kind of interpreted this as, okay, if people under Genius Act can get a state or a federal license to engage in certain activity, and there's the potential that that will allow them to have access to Fed payment rails, what about, quote unquote, regular fintech or like regular fiat money world outside of stable coins? So I kind of interpreted this as like an attempt to create parity between potential stablecoin issuers who have some sort of license under Genius versus sort of standard fiat money transmission. That said, most of what we call fintech operates through FBOs, so that they don't have to get money transmission licenses. So I mean, I do appreciate the effort that like there are actual legislators attempting to legislate.
Totally.
I'm not clear to your point. It's like, well, okay, if you still have to go and get, I would interpret this 40 is the minimum in order to qualify potentially for access to Fed payment rails if this were to become law as it's currently written. But if you're doing business across all 50 states, you would still need to hold, presumably you would still need to hold all the relevant MTLs. And so it's an incremental layer of work, which is not how most fintech actually operates today anyway. I guess like maybe it helps somebody like a Western Union or like a MoneyGram, like a true sort of classic money transmitter. I'll admit, like I haven't spent as much time in that space researching companies that specifically hold MTLs and use them in kind of like the classical way that they're intended to be used. So like, I'm sure that there are some entities that could benefit potentially from the introduction of this. But I think I had the same kind of reaction it sounds like you had that was like a bit confusing of like, does this actually make anything easier? Who is this for? The Fed still has a tendency to say no for any or no reason that it will or will not reveal should it decide to. So it wasn't clear to me that this really is a practical solution, but I do appreciate A for effort.
Yeah, I mean, it's like that saying of like, never criticize the behavior you want to see more of, right? So like on the one hand, I feel bad being critical because it's like, please pass laws, modernize what we're doing. The dual banking system is kind of dumb. Like, go ahead, do this. Like, I love it. So on the one hand, I think that's great. And I think like to compare it to crypto companies and Genius and like national trust banks, like I view the national trust bank thing as the OCC sort of stepping out of its lane a bit because like that's not what national trust charters were really meant for. And like, you're kind of finding a back doorway into payments accounts and narrow banks and that kind of stuff. So I think this is a much better, more legitimate attempt at kind of addressing this problem. So on the one hand, I like that. But I agree with you that, I mean, it's weird because like say your PayPal as an example. PayPal has MTLs in every state and territory that it needs to operate in. Shout out Montana for not requiring that for reasons that still are a mystery to me. PayPal is getting a bank charter. And so like I guess the thing I'm curious about is if you operate at a sufficient size and scale where you have gone from, okay, we don't want to have a bank partner that we do like banking as a service through to get access to payments. We want to actually take the step of getting money transmitter licenses. I was just reading today that Shopify has quietly been acquiring a bunch of money transmission licenses. So that's the path, right? Is you go from partner bank to MTLs because that gives you more control and you can kind of seize a little bit more of the economics for yourself. And then the last step after that traditionally is, okay, well, we're roughly a bank. We do a ton of payment stuff. Let's just become a bank. And there's multiple different approaches to becoming a bank. You can get an ILC if you want to avoid the Bank Holding Company Act. You right now at least can get a national bank charter and become a national OCC chartered bank. The door is wide open for that. And so I don't really quite understand like where this fits in that trajectory and where it saves money. Like, okay, we're in the process of ramping up our MTLs. Hey, we've gotten 40. Instead of getting the last 10, we're going to get this other thing instead. Like,
well, and it doesn't solve for getting the last 10 anyway. You still need to have the rest of the licenses if you're operating in those states. It doesn't fix that problem. It's incremental work. It doesn't mean you don't need to get those. Yeah.
Yeah, well, and then to your point, like the standardizing across the MTLs and having that kind of common framework, like there is a movement to, if you have MTLs, you roughly need to be operating this way, right? And MTLs in big states like California or New York, they're pretty serious in terms of like the requirements that you have to go through. Like you get quite a bit of prudential-like supervision as a big MTL holder in a state like New York or California, and so I just don't really see where it fits in the trajectory, assuming that the charter door remains open. And I guess that's maybe the point to end on is if the charter door slams shut again and we have a swing back on the regulatory side and it's like, actually, we're not giving out new bank charters, this could be slightly advantageous because then you could at least get a master account and things following that MTL path. So maybe it's sort of hedging for the risk that future regulators won't be cool with giving out bank charters the way they are now, which if you're like the Financial Technology Association, you might want to hedge that risk from a regulatory perspective, right? Like it's great right now, but maybe you want to hedge the risk of that charter door being slammed shut on you and having to sort of have an alternate path to go down. I will also say we are continuing to inch towards narrow banking, just generally, it seems, across a whole bunch of different things. And it would be nice if the banking lobby stopped fighting on the stablecoin yield thing quite so hard and started fighting more on all the other areas where narrow banking is sort of creeping in. Because I actually do share the concern about credit creation, deposits, payments, like that whole sort of splitting up of those activities and the effect it has on credit creation. Like I'm actually sympathetic to that argument, but it seems like it's happening everywhere. And this is also potentially an example of that.
I'll be interested to see if it goes anywhere beyond the press release that showed up in my inbox.
Well, I wouldn't bet on it, just given the way Congress does Congress things these days, but we shall see. Jason, let's end, as we always do, with some Can't Let It Goes. I'm going to go first because you have like 3 or 4 ones that you might
I'm cutting
mention.
myself down. I'm cutting myself down to 2. I can't. That's all I have time for today.
Fair enough. Yeah, the one you cut, I think we really don't have time for. We'd spin off in a totally different direction. All right, my Can't Let It Go, and I mentioned this on Twitter, I think, is it has been reported that the prediction markets, Kalshi and Polymarket, are getting into adjacent, I guess, areas, you could say, by offering crypto perpetual futures, or perps, which is basically the ability to have a continuous leveraged bet on the price of cryptocurrency assets. So instead of doing what you can already do on the prediction markets, which is have a discrete non-leveraged bet on where the price of Bitcoin or Ethereum or any of the different coins out there, instead of having a bounded bet at like the end of the day or the end of the week on that you don't have any leverage on, why not just have a streaming ability to just continually bet on the price of crypto going in a particular direction with leverage built into it? That's what perps are. Perps are, in fact, the single most popular and most profitable category within the world of crypto investing. And apparently Kalshi and Polymarket are leaping into this environment. And I don't know. I think that this tells us pretty much everything we need to know about what these platforms actually care about. They say certain things, but when you look at their behavior and the type of action they're trying to attract in their casinos, this tells me pretty much everything I need to know.
Okay, I'll do my one that I find I'm actually can't let go of first, and then we'll end on a lighter note. Alex, I know that you don't spend your entire life abroad as I do, but have you ever run into the situation where if you're traveling outside the US, you swipe your card at a merchant at a point of sale, and it generously offers you the ability to convert and pay in dollars as opposed to whatever local currency you might be in?
I have.
So this is called dynamic currency conversion, and it is literally always a bad deal, as anyone who works in our industry and listens to this is probably aware of. I'll say I've been in Mexico for nearly 10 weeks, and I actually have not seen, at the ATMs I have seen it, but at merchant point of sale, I only ran into it once, and it's because I was looking at my receipt and realized that the merchant had done it without asking me, which is against network rules. And yes, this was for like a 80 peso transaction. So ultimately, like the amount I was, getting ripped off was like less than $1. But because I am me, I did actually initiate a chargeback, which I won. A chargeback for the delta in the amount is what I was trying to get.
Got it.
So yeah, PSA, dynamic currency conversion at point of sale, always a bad deal, purely predatory, shouldn't be a thing. If Rohit Chopra had done his job when he was in office, he would have looked at things like that.
It's a great one. That's a great one. One, I guess it's predatory on behalf of like the merchant processor that's working with the merchant. Like, who's pocketing this money?
So my understanding of why this is so common is everybody in the chain gets it, including the merchant. I think they rev share. So like technically, because yes, I did research this. They're supposed to show you the terminal, which like discloses what the pricing is. And the merchant is not supposed to steer you into picking one or the other, because there's a rev share to the merchant if you opt the more expensive option to convert and pay in your home country currency, as opposed to paying in the foreign market currency and taking the network exchange rate.
That is, I mean, like, that just feels like a tax that is people are getting tricked into paying that's shared amongst all the providers in the chain. Yeah. Not good.
So if anyone from Visa, MasterCard is listening, I get it, but like that is literally the definition of a predatory product and really shouldn't be a thing.
Yeah. All right. Good PSA.
Okay. So let's end on a light note. Alex, were you a fan of the mid-zeros teen soap, The OC?
Jason, I am in my late 30s. Of course I was a fan of The OC. Of course.
Were you aware that Benjamin McKenzie, a.k.a. Ryan Atwood, has become like a fairly famous and well-known critic of the crypto industry?
I was aware of this. I was aware because he wrote a book, right?
With Jacob Silverman, yeah. So I was actually asking Claude to explain how this happened. And the story is very mundane, but evidently McKenzie had a friend who had previously given him, quote, the worst financial advice of his life. And then years later encouraged him to buy Bitcoin. And McKenzie was like, what's this? Apparently has an economics degree from University of Virginia and had also studied a long history of financial fraud. So I guess Ben McKenzie and I have that in common.
There you go.
And when he came across an article from Jacob Silverman, the two met. Of course, they both probably live in Brooklyn somewhere. Got a drink, and the two ended up, I think, writing a book together. He also demonstrates a remarkable level of self-awareness, because asked like why he thought he could make an impact, he apparently answered in an interview, I think it was with Time, quote, if I have a superpower, it's as a mid-level celebrity and econ dork. Those two skills don't often overlap, but they seem to be potentially particularly powerful here because crypto had gathered up so much momentum that it was drowning out other voices. So he had a movie that just came out. I've not had the chance to see it yet, but I hope to do so at some point. Everyone is lying to you for money is the film.
That is fascinating. The reason I remember this is when the book came out, it really bothered crypto people more than because I mean, it's not like there weren't other people being critical of the crypto space, including people like in the industry who kind of know the ins and outs of how all of this works. And yet it wasn't any of those things that were really setting them off. It was this book. And so I did take note with special interest that Ryan Atwood being anti-crypto really seemed to get under the skin of a certain portion of the crypto community, which always sort of stuck with me as mildly entertaining.
I guess we will have to leave it there. Next time I talk to you, I will finally, presumably, be at home in the Netherlands.
I wish you luck on your journey. If you want to watch old episodes of the OC and then talk about that on the next podcast, I'm game. I want you to always know that this is a safe podcast for early 2000s TV nostalgia conversations. So whenever you want to get to that, you just let me know.
It was a simpler time.
It really was. Thanks, buddy.
Till then.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.